Fusion Mobile, quality e-learning experience on the go.
You are welcome to Fusion Mobile learning platform. I'm Olokolu by name, the commerce tutor rather, and this class will be treating the topic credits, and we'll be discussing on the meaning of credit. Thereafter, we'll look at the basis of credit sales. You understand? Then we'll move to the advantages and disadvantages of credit sales. So we are going to look at different types and sources of credits. Thereafter, we'll move to the finance house. Now, the first thing we have is the meaning of credits. Wow, interesting. Credit occurs whenever the seller transfer the value of his goods directly to the buyer without cash being paid immediately by the buyer. So that means credit as what? As occur. So it is the process of what? Of transfer of value, or whereby the seller gives permission to the buyer to take possessions and make use of his goods without payment being made immediately, or with a promise to pay in the future. So whenever the buyer makes promise to pay in the future to the possession of the goods of the seller and make use of such goods, so what happens? Credit sales has occurred. Generally, that is what credit sales is all about. And when granting credit, what happens? The credit worthiness of the buyer have to be taken into consideration. The seller have to consider the credit worthiness of the buyer. So they have to consider that. That what have to consider. So how can the buyer be able to actually know the credit worthiness of the buyer? That can actually get out such an information through the status inquiry agencies. We have some status inquiry agencies that will be able to determine whether the buyer will be able to meet up the credit whenever such obligation becomes due. So the next thing we are going to look at is the basis of credit sales. Wow, this actually, what are you going to look at when you have to grant credits? What are you going to look at? First thing you should look at is the income of the buyer, the income of the buyer, and also the present employment of the buyer. You have to consider that too, and also the present or availability of a guarantor. So there should be a guarantor. The person that will guarantee such a person in which has sold goods on credit to, and also you have to consider the integrity of the person in which the loan has to be given to. That has to be taken into consideration. You have to consider that just thing again, and also the source of income the source of payment. Where is the person as source for the money to repay such goods being sold on credit to the person, and also you have to take into consideration, and also the period of payment, that is time of payment. When is the person going to pay such debt? So all those factors are to be taken into consideration before granting credit to the buyer. So we call it the basis of credit sales. Now the next thing we are going to be looking at is the advantages and disadvantages of credit sales. We'll be looking at the advantages and disadvantages of credit sales. Now the first thing we have is the advantage of credit sales. Now when talking about credit sales, the advantage we can actually derive from the credit sales is as thus. Advantages. Number one, it helps to increase profits. Number two, it increases sales. Increasing sales. Number three, it enables the buyer to enjoy goods without payment being made immediately. So it increases the profit. And again, number four is that credit sales improve the standard of living standard of living of the buyer, since he will enjoy goods without paying what immediately. So help to improve the standard of living of the buyer, and also it helps what enables the buyer to enjoy goods without what payment being made immediately. So without payment being made immediately. So also what happened? It increased what actually caused increase in sales, and also increase in what in the profits of the seller. In the profit of the seller. So it's brought about enjoyment of goods without what payment being made immediately. So again, it also encourage bulk purchase. So it helps to encourage bulk purchase. It encourage bulk purchase. It enables buyer to buy in bulk. So which helps to increase the sales of the seller. Now the next thing we can talk about is the disadvantages of credit sales. Wow, disadvantages of credit sales. Disadvantages of the credit sales is that one, it increases the price. It increases prices. So it increases what? Prices. Increase prices. Number two is that customer can be tempted to buy more. Can be tempted to buy more. To buy more than is what is worth. To buy more than his capacity. Number three is that it can lead to bad debt. Can lead to bad debt if the buyer should refuse to pay. What happens? That leads to bad debt to the seller. And number four is that it causes capital being tied up. So it causes capital being tied up. So it causes capital of the what? Of the seller being tied up. So what will happen? The capital of the seller will be tied up in debts. Number five is that it can lead to court action. Credit sales can actually lead to what? Court action to the refusal of the buyer to pay or to settle the seller. That can lead to court action. And again, is that even though the goods are being sold on what? On credit, in some credit sales aspect, the seller has the right to repossess the goods. Repossess the goods. So seller have rights to repossess in some aspect of credit sales. So these are the disadvantages of the world of credit sales. So it is going to increase prices, and again going to cause that customer to be tempted to buy more of the goods. That is what happened. The customer can be tempted to credit sales to buy more than its capacity, more than its worth. We can lead to what? Which can lead to the customer not be unable to pay, and again it can also lead to the bad debt to the seller. So that is where if the customer is unable to pay to meet up his obligation of being paying to the seller. And the next thing is that it can cause capital being tied up. Yeah, it causes capital being tied up. So too much of credit sales, what will happen will cause the capital or the sellers to be tied up in debt. And again is that it can lead to court action through the refusal of the buyer to pay for the goods. So if the buyer should refuse to pay for the goods being bought, what happen? That can lead to court action. So it means the seller has the right to sue the buyer through the refusal of of the buyer to meet up with his obligation. Now the next thing is that seller has right to repossess in some aspect of credit sales. Seller will have the right to repossess no matter how number of installments the buyer has paid. So in some aspects of credit sales like hire purchase, the seller usually have the right to repossess. So now we'll be looking at types and sources of credit sales of credit. So now we have the mortgage, we have the loan and overdraft, we have the debt factoring, we have the hiring and leasing, we have hire purchase, we have deferred payment, we have credit card, we have club trading, we have budget account, we have monthly account, we have book me down. A lot of a lot of types of credit sales exist. So we are going to look at this. But the major one we'll be treating now is the first 6 period of time. So period of time. We have a lot of credit sales, but let's just look at this and quickly explain this. Especially hire purchase, have a lot of details like that, and so we have to do that. But the first thing we have is the mortgage. Wow, interesting. Mortgage. So this is when building societies or bank or mortgage society or mortgage bank tends to grant loans and credit facilities to individuals in order to enable such individuals to build housing properties or to own a house. So loan will be given to the person in order for the person to acquire a house. So when talking about mortgage bank, it's usually an agreement between the mortgagee and mortgagor. So the agreement is that the mortgagor is going to give the amount of loan to the mortgagee in order for the mortgagee to be able to acquire the landed property or something like that. So that is what mortgage is all about. That is what the mortgage is all about. So now the next thing is that loan is usually given to or money is usually lent to be able to acquire or own a house. That's what mortgage is all about. So mortgage. So the next thing is let's look at the loan and overdraft. Loan and overdraft. Loan is usually given by individuals or firms or governments to other individuals or to other firms, you understand, and to government itself. Government can also insecure loan. So for a fixed period of time, as a result of to derive interest on such loan. So anybody giving a loan is that the money is being lent to such an individual in return for what? In return for the payment of the loan, and also at the fixed rate of interest. So the person will be required to pay interest and that of the capital also. So loan is usually granted the person, and that person is going to use that amount of money for a period of time. So based on the agreement, when the period lapses, what happens? The person will be required to repay the loan and also pay the interest on the loan. So generally, interest is usually paid on a loan, and it is the responsibility of the person in which the loan is being granted to repay the loan and also repay the interest. So the capital and interest will have to be paid to the person in which the loan is being taken from. Now the next thing is overdraft. This is usually granted by the bank. It's usually granted by the bank to a current account holder. It's usually given by the bank to a current account holders. So the current account holder will be required to withdraw more than what he or she is having in his bank account. So overdraft occurs when a person is being allowed by the bank to withdraw over the amount he is having in his bank account. For instance, an individual having 5,000 naira in his account can be required by or allowed by the bank to withdraw over and above what 5,000 naira is having in his account, and might be allowed to withdraw 10,000 naira based on the required maximum that the bank allowed its customer to withdraw, the account holder to withdraw. Now the next thing we can talk about is debt factoring. Wow, this is very interesting credit sales, and this occur when the trade debt, like the trade debt of a country or of a company or organization is being sold to another organization or banks, you understand, which we refer to as factor. So in return, whereby the factor or the bank is going to buy the debt from the company at the value which is less than the actual value of the debt. And what happened when the debt then due? What will happen? The bank or the factor will collect the face value of the debt from the debtors. So it's also a source of credit sales, whereby what happen, the factor will allow a period of credit to the company. They will take the value of the debt from the company and pay the company directly. But what happened, the amount they are going to pay the company will be less than the face value of the debt, will be less than the face value of the debt. So when the period of the debt due, what happened, the factor will collect the face value of the debt directly from the debtors. So that is one of the sources of credit sales. So we call it debt factoring. Now the next thing we have is to look at hiring and leasing. So this occurs when the owner of a landed property give the right to another person, to have an exclusive right to make use of his property. To make use of his property in return for a fixed amount of money or for a fixed payment. That's what we refer to as the leasing or hiring. So what happened? The person will give his right to his property to another person, to the exclusive right of that person, to make use of the assets or the property within a certain period of time in return for a fixed payment, or a regular payment based on the agreement between the parties. So hiring and leasing always serve as the source of credit sales. So what happened? The owner of the property will give it the right to another person to make use of the assets within a period of time in return for payment or money for payment. So the next one is the hire purchase. Interesting. Hire purchase. We have the hire purchase. Wow, it's very, very interesting. This is also one of the interesting types or source of credit sales. Interesting source of credit sales used by large organizations, better used by organizations to acquire especially some amount of durable goods or durable properties. So hire purchase usually occur when the hirer or the seller grants the buyer the right to take possession of the goods and the buyer and make instrumental payment, that is some fixed amount of payment regularly until the final payment is made. That is the final instrumental payment is made. That is when the seller is going to retain the ownership of his goods. So what happened is that involves some period of granting credit sales, whereby the seller is going to give the transfer the possession of his goods to another person, which is the hirer. So whereby the hirer will be paying some instrumental payment, you understand, with a fixed payment within a regular period until the final instrumental payment is made. That is when the owner of the goods is going to retain the ownership of the goods. So if the final payment is not made, what happens? The owner cannot retain the ownership, cannot retain the ownership of the goods. So the owner still remains the owner of the goods until the final instrumental payment is made. That is when the owner is going to retain the ownership of the goods. That means when talking about hire purchase, actually deals with a contractual agreement between two parties. Totally deals with contractual agreement. So it's having the legal backing. So it's really in form of a contract. So that's what we're talking about. Hire purchase. So in the law, the hirer has the right, that is the buyer, the owner of the goods or the seller has the right to repossess his goods. He's having the right to repossess the goods as a result of the failure of the word of the buyer to make the word instrumental payment. So now this category of what of credit sales is available for durable goods, like tricycle, motorcycle, motor van, equipment, machinery. So whenever the credit sales is being granted, what happen? The person in which the goods is being sold to will be what? We have possession. Such a goods will be in the possession of that person. That person will be making use of that goods, but really he is not the owner of the goods until he finally pays the final installment. The final installment, that is when he becomes the owner of such goods. Now let's talk about the hire purchase. And when talking about, let's look at some features of hire purchase. In our explanation, we actually talk about some features, but let's look at that plainly. Now the first feature we are going to look at is that the hire purchase, what happened? The hirer has only possession. It does not have the ownership of the goods. He is not the owner of the goods until he is able to pay the final installment. That when he becomes the owner of the goods. So it is only having possession of the goods, not ownership. That is, the hirer is having possession and not ownership of the goods. And again, one of the features we can also see in hire purchase is that the seller is having the right to repossess the goods. Is having the right to repossess the goods. And what happened in hire purchase? What happened? There is some amount of fixed instrumental payment. Instrumental payment is usually required. That is, fixed amount of instrumental payment is required in the contract. So what happened? The hirer will be paying some instrumental payment within the period of time to meet up the sales. And again, when talking about the hire purchase contract, so what happened? Immediately the goods are being transferred from the seller to the buyer. What happened? The seller can require for initial payment. Initial payment might be required based on the agreement between the seller and the buyer. So might be initial deposits. And also in hire purchase contract, the amount in which the goods will be sold, which refers to as hire purchase price, is usually higher than the cash price of the goods. But there will be hire purchase interest included in the calculation of the goods, so there will be higher purchase interest to be required. So what happened? The higher purchase price is higher than the cash price of the goods. So higher than the cash price of the goods. And again, if the buyer should default, and he refuse to pay the instrumental payment, what will happen? If the buyer should default, what will happen? It means the seller has the right to repossess the goods within a period when the buyer defaults. So having the right to repossess the good. And again, the contract requires that whenever the buyer has paid 1/3 of the price of the goods, what happens? The seller can only repossess the goods through court action. What happens? That means court action will have to arise. So that is what the law is saying. That is in hire purchase contracts, that is what the law is saying. So let's look at the parties to hire purchase contracts. Generally, we have two parties to hire purchase contracts. We have the hirer, which is the buyer of the goods, and we have the owners or the seller. So we are a vendor. We can also refer to as hire purchase vendor. So you can be the vendor, the seller, or the owner of the goods, while the second party is the hirer or the buyer. So these are the two parties we have. Sometimes we may have a finance company. So the company will serve as a link between the buyer and the seller. That is between the vendor and the hirer. They can serve as an intermediary. So they can serve. Sometimes you can have three parties to hire purchase contract. We have three parties to hire purchase contract. So we are going to look at some advantages of a hire purchase. So hire purchase is advantageous to the seller and can also be disadvantageous to the seller. It can be advantageous to the buyer and also be disadvantageous to the buyer. Now, the advantages of hire purchase to the seller is that it's going to increase the sales of the buyer and profit of the buyer. You're going to increase the sales and profits of the seller. And the advantage to the buyer is that what happens? It enables the buyer to enjoy goods is not yet to be paid for. It's going to enjoy the goods is not yet to be paid for. And also to that process, what happens is there will be an improvement in the standard of living of the buyer. There will be an improvement in the standard of living of the buyer. So disadvantage is can also arise in that aspect. So I will employ you to read more on hire purchase for a better understanding. Now the next thing is for us to look at the word deferred payment. The deferred payment. And when you look at the deferred payment, so deferred payment also is as the source of credit. And when talking about the deferred payment, this is similar to what hire purchase, but entirely different. This deferred payment is when this occurs when the buyer has possession and ownership of the goods after paying an initial payment. So this is when property is transferred from the seller to the buyer, from the seller to the buyer after making some initial deposits. So when the buyer makes some initial deposits to the seller, what happens? There will be transfer of possession and ownership from the seller to the buyer after there is a payment of initial deposits to the seller. So what happens? The buyer will continue having the possession of the goods and also become the owner of the goods. You can claim the ownership of the goods in this type of credit sales. So we refer to it as deferred payment. So there's a lot of differences between hire purchase and deferred payments. Is that the major difference is that in this place, what happens? The hirer or the buyer is only having possession and not ownership. But in this place, the hirer or the buyer is having both possession and ownership of the goods. This is with more durable goods. Goods are more durable, and this is with less durable goods. Both actually do with durable goods. That means there is always be some similarities between them, and then in this similarities we can also see is that both what happened in hire purchase, the buyer is having possession, and in this also the buyer is also having possession. So that is the similarities and some differences we can see in hire purchase and deferred payments and deferred payments. In this, what happens? The buyer can also repossess the goods. The seller can repossess the goods. What happens? In deferred payment, the seller cannot repossess the goods. You cannot repossess the goods like. So it's not possible for the buyer to repossess the goods. Now, the next thing we'll be looking at is the credit instruments. We'll be looking at some credit instruments, some documents used in credit sales. So the next thing we have is the credit instruments. So we'll be looking at credit instruments. Thereafter, we're going to move to the finance house. So credit instruments. So credit instruments are actually the written documents that are used to serve as evidence, essential evidence as for credit sales. They are used as evidence that credit sales has occurred or credit transactions has occurred. So whenever credit transactions occur, what happens? These credit transactions are written down as an evidence of the transaction. So we have different credit instruments. So that there are written documents. So we have different types. We have a bill of exchange, written down. So we have promissory notes. We have letter of credit. We have credit cards. We have debentures. Debentures is also a form of credits. When that occurs, what happens? We have written document for that. We have trading check. We have vouchers. We have hire purchase contracts. We have bonds. We have bank credits. So these are the credit instruments we have. So we have bill of exchange. We have promissory notes. The promissory notes. We have a letter of credit. We have a credit card. We have debentures, trading check. We have vouchers. We have hire purchase contracts. We have bonds. We have bank credit. Now the next thing we have is the finance house. We're going to look at the finance house. So generally, the finance house are the intermediaries. They serve as an intermediary for sourcing for credits where they help those who are in need of credits to help them to source from some form of credits. So they help them to source for money. So help them to source for money and help them to source for loan. So that is the function of the finance house. And this finance house includes the merchant banks, the commercial bank, the insurance companies. So they assist those who are in need of funds to help them to source for such funds. That's the responsibility of the finance house. I've said earlier, they include the commercial bank. They are also called intermediaries, you understand. So in this topic, we actually discussed the meaning of credit. Thereafter, we look at the basis of credit sales. So we also look at the advantages and disadvantages of credit sales. Thereafter, we'll move to the types and sources of credit. We also look at the credit instruments, and lastly, we will look at the finance house. So if we need more, if you have some confusion as regards to the topics and you want to understand more better what happened, do not hesitate to replay the video. And again, some questions will be displayed on your screen. Do well to attempt such questions. Thank you.